The last time I felt this way about the market was 1999. Now, I've been investing for over 30 years. I've lived through the dot-com crash, 2008, COVID, the April 2025 tariff sell-off, and right now, with the markets at all-time highs and AI stocks running the way they're running, I'm seeing patterns that remind me of something I've watched happen once before. The difference is that in 2000, a lot of those companies had nothing real underneath them. AI is real. There's a little difference there. But that's exactly what makes this comparison more dangerous, not less. In 1999, the internet was real too. It changed everything eventually. But the NASDAQ still fell 77% between 2000 and 2002. Not because the technology was fake, because the valuations had run so far ahead of what the technology could deliver in the near term that a correction became inevitable. Now, there were a few other things that was happening with those stocks at the time, but we'll talk about them later. Now, I'm not here to tell you AI is a bubble. I don't know that. Nobody knows. But what I can tell you is what the setup looked like the last time I had this feeling and what I did when the crash came. Because if I'm right, you need to hear this before it happens. And if I'm wrong, understanding how these downturns actually unfolded is still the most valuable education a long-term investor can have. I want to take you through 4 market drops that I personally lived through because understanding what caused each one, what it felt like from inside it, and what I did about it, that's the best preparation I can give you for what might be coming. 2 of these you may have already been through already. COVID in 2020, the tariff sell-off in April 2025, both came back fast. And I think that speed may have taught some investors the wrong lesson, that every drop works the same way. The 2 that I really want you to understand are the dot-com crash and 2008, because those lasted years, not weeks. And the one that feels most relevant to today is 2000. Now, here's something I want you to pay attention to throughout this video. Each crash taught me something different. Some of those lessons came from mistakes that I made myself. Some came from watching what happened to other people around me. And I'm going to point them out as we go, because the lessons are just as important as the history. Picture this. It's the late 1990s. The internet is changing everything. And Wall Street has completely lost its mind. Companies with no revenue, no profits, sometimes no real product, just a website and a .com in its name. And they're going public and doubling on their first day of trading. VA Linux went public in December of 1999, priced at $30 a share, closed its first day at $239 in one day. Red Hat had its IPO that same year, 227% gain on day one. The NASDAQ went from around 1,000 in 1996 to over 5,000 by March of 2000, a 400% run in 4 years. And the thinking was this was a new economy, kind of similar to today. That old valuation rules didn't apply anymore. Same thing as today. I'm watching some of these stocks and I'm thinking, I don't understand how this is worth what they're saying it's worth. The math just didn't make sense to me. But the stocks kept going up, so it's like, what do I know? Now, I wasn't heavily into tech stocks at the time. I couldn't understand the valuations on a lot of these companies, so I was mostly watching from the outside. Until a friend of mine, someone who I thought was really on top of the market, recommended 3 stocks to me. MCI WorldCom, Global Crossing, CMGI. I trusted his judgment. He could talk about these stocks all day long and how great they were. So I bought them. Now, the way I invested back then in my trading portfolio was in chunks, big positions, go for broke. And then I watched them start turning against me. I sold, took a loss. And here's what eventually happened to all 3. Fraud, bankruptcy, near total collapse. And here's the thing I have to be honest with you about. What I did was not smart at all. It wasn't good research or good instincts. I got out because the position was large enough that when it moved against me, it hurt enough to force my hand. Had I put less in, I might have been more comfortable sitting on the loss. Now, would I have ridden it all the way down to 0? I honestly don't know. I was naive as an investor at the time, but I didn't know it. Here's the lesson that I took from that experience. And I actually changed how I invest because of it. I set a standard amount that I invest in anything. If I think the investment is riskier than normal, I put in half the amount. The position size is decided before I buy, not based on how excited I am, not based on a tip from a friend, not based on how much I've already made or I've lost. It's a rule, a cardinal rule that I have. Position sizing isn't just risk management, it's emotion management for me. And a mistake taught me that. Not a book, not a class, a mistake. Now, here's the second lesson from that period, and this one connects directly to what's happening in today's market. The market can recover while individual stocks never do. Think about Cisco, one of the most important technology companies in the world. Real product, real earnings, a company that literally built the backbone of the internet. If you had bought Cisco last year, you're probably in pretty good shape today. But if you bought Cisco at the peak in 2000, you spent the past 25 years just trying to get back to even. The index has recovered. Cisco as an individual stock took a generation. Now, why does that matter right now? Because the same question applies to AI. The technology is real. The companies building it may be real. But if you're buying individual AI stocks at peak valuations, you could be right about the technology and still spend years waiting to break even. That's not a prediction, that's a pattern. And I've seen it once before, which brings me to something else that matters just as much as what you own. Don't get heavy in any one sector. That's what destroyed a lot of the tech investors in 2000. It wasn't just that individual stocks fell, the entire sector got repriced or got hammered. And when you're over-concentrated in one area of the market, there's nowhere to hide. And when that sector gets hit, it gets hit. And it doesn't matter how good you think the technology is. If everyone is selling tech, tech falls, all of it. So spread it out. Now, 7 years later, the financial system nearly fell apart. And this time I wasn't watching from the outside. I was working inside the mortgage industry. And when the mortgage crisis hit, I was right there in the middle of it. So the 2008 crash is the one that most people think they understand. But I want to tell you what it felt like from where I was standing, because I had a view of it that most people didn't. And I want you to understand what was happening inside the financial system during this period. The movie The Big Short does an incredible job capturing it. Watch it. It's based on a true story, and it explains the mechanics of the collapse better than anything I've seen. But the movie shows it from people who saw it coming and bet against it. I want to show you what it looked like from inside the industry that was at the center of it. Housing prices had peaked in 2006 and had started quietly falling. Banks had spent years writing mortgages to almost anyone who walked through the door. No income verification, no documentation, no down payment, 100% loans. I mean, crazy loan products. Here's something that almost never gets discussed. I was a mortgage broker during this time. I saw loan products that I knew weren't right for some borrowers. I could see some that were higher risk for the borrower. But the underwriting standards were not set by me at the desk. I could explain the terms, I could explain the risks, I could explain what the payment could become. But if the borrower qualified under the lender guidelines and wanted to move forward, the system was built to move that loan through. So who's to blame for all this? You know what? Everyone. Everybody's to blame. The lenders who created the product, the real estate agents who pushed houses to the borrowers at the max qualifications, the borrowers themselves who took out loans they couldn't sustain and were betting on their house appreciating. Now, hey, there were some innocent casualties along the way. There sure were. But you also had some that were guilty, and one especially that I look at was the rating agencies. Moody's, S&P, and Fitch. They were the ones who were stamping AAA ratings on bonds that were packed full of these kind of loans. And they were putting the highest possible safety ratings on them, reserved for things that were supposed to be nearly risk-free. What none of us on the ground knew, what was being built on top of these loans, the derivatives, the mortgage-backed securities, the complex financial instruments that were being sold globally. We didn't know the full picture. September 15th, 2008, Lehman Brothers, 158 years old, filed for bankruptcy. the largest bankruptcy in American history. The next day, the Federal Reserve bails out AIG with $85 billion. That's the environment people were trying to invest through. Foreclosure filings exploded. I saw the notices in my local newspaper go from a page or two to 10, 20 pages. And I recognized names in these listings. Some were friends. Some had overreached, okay? They made a mistake. Some had gotten laid off and didn't have the savings to get them through. Some had simply bought at the wrong time. Between October 2008 and early 2009, this country was losing more than 700,000 jobs every single month. I was picking up my kids one day in the school pickup line, and we live in a military town, so there's a lot of military families that had kids at the school. Now, the military people, they have a steady government paycheck that includes money for housing. They got job security, and I'm sitting there watching my professional world and my portfolio fall apart simultaneously. And I'm looking at these military parents picking up their kids thinking, y'all have no idea what's going on out there. And unless they owned a home, they were pretty much insulated from it, other than, investments that they may have. My portfolio was dropping every single day, and I want to be straight about, what was going through my head at that time. I looked at my portfolio and I thought about selling one day. And one thought that I had was, well, it's getting pretty close to zero, might as well hold. Now, that's not wisdom. That's not strategy. Call it situational depression, call it giving up. The real reason that I didn't sell wasn't a rule that I had written down. It was what I owned. I looked at my core holdings. One had been paying dividends for longer than most of us have been alive. Another one had survived recessions, oil crisis, wars. These weren't speculative bets. These were companies with real earnings, real products, real history. The S&P 500 bottomed on March 9th, 2009. Then it started coming back. And here's something I watched closely during that recovery that I filed away and I never forgot. The stock market had already made back a significant portion of its losses while the broader economy was still struggling. Jobs were still being lost. Housing was still in trouble. By almost any everyday measure, things still felt bad. But the stock market doesn't wait for the economy to feel better before it moves. It moves ahead of it. People who waited until conditions improved, until it felt safe to get back in, they had already missed a meaningful part of that recovery. The market had moved without them. Know what you own. Not just the ticker symbol, not just what a friend told you. Know the business, know why it exists, know whether it can survive a prolonged downturn. Because in the middle of a crash, your conviction in the company is the only thing that's standing between you and a decision you'll regret. Position sizing gives you the ability to hold. Stock quality gives you a reason to hold, and you need both. Now, I want to share something else I watched happen during 2008 that permanently changed how I think about my own portfolio. I saw retirees who had been 100% in the stock market. They needed income for their portfolios, pulling money out every month to cover their living expenses. And now their portfolios had been nearly cut in half, and they had no choice. They had to sell falling stocks just to pay their bills. That's the worst possible position to be in as an investor. They had never repositioned as they got older. Now, they were investing at 65 the same way they had at 40. I watched that happen and I made myself a promise. I don't invest the same way today that I did 30 years ago. As I've gotten older, I've repositioned some of my portfolio to better insulate myself if there's another serious drop. The goals shift. At 30, you're building. At 60, you can be building, but you're also protecting. Growth still matters, but so does making sure a market crash doesn't force you to sell at the worst possible time just to meet your monthly needs. The closer you are to needing that money, the more that distinction matters. 12 years later, a pandemic shut down the entire global economy in a matter of weeks. And for the first time in my investing life, I wasn't trying to survive a crash. I was looking for the right moment to buy. On February 19th, 2020, markets were at an all-time high. No warning signs inside the financial system, no cracks in the banking structure, nothing like 2007. Then COVID hit, and in 33 days the market dropped 34%, fastest crash I had ever seen. Circuit breakers triggered 4 times in 2 weeks, halting trading and just trying to calm the markets. Something like that had never happened before. Goldman Sachs said recession probability was 45%. JP Morgan said 60%. And I watched people panic. I watched people sell. The fear, man, fear was real. This wasn't just money at risk. It was your health, your family. People just didn't know how bad this was going to get. But here's what I kept coming back to. The cause was known. This wasn't years of hidden rot surfacing inside the financial system. The economy was being deliberately restricted because of a public health emergency. That made it fundamentally different from 2008. The question was how long the shutdown would last, how much damage it would do, and how much support would come behind it. That's a different calculation than when the financial system itself was broke. I also had something in 2020 that I didn't have going into 2008. I remember what I had watched happen during the 2009 recovery. The market had moved long before the economy felt better. People who waited for the all clear missed the move. I wasn't going to make that mistake. Now, I wasn't trying to catch the exact bottom. What I was watching was for technical signal, something that told me that the selling was exhausting itself, and that a turnaround was becoming more likely. Now, I'm not going to break down those signals here. That needs its own video. When the market reached a point where the technicals were signaling that a shift was due, that's when I cautiously started buying. And I want to be clear about what cautiously buying means. I didn't put a lump sum in and call it a day. I built positions gradually, a little at a time. As the market confirmed what the signals were telling me, I would add a little bit more, methodically, patient, into that weakness. While the headlines were still screaming, the S&P 500 gained 45%. In the 3 months after it bottomed, 45% increase there. The people who waited for the all clear, for the fear to go away, missed most of that recovery because the strongest market days often happen before the news feels safe again. See, history repeating itself. And the people who sold, many didn't get back in at better prices. They either missed the recovery entirely or bought back in higher than where they sold. These were people who made a completely understandable human decision. I can't fault them. And it cost them in a way the charts will never fully show. Not all crashes are the same. Understanding what caused it changes how you should respond. When the cause is visible and potentially reversible, a policy, a health event, an external shock, that's a different situation than when the system itself is broken from the inside. In 2008, nobody could see the bottom because nobody really knew what was really inside those mortgage bonds. In 2020, the economy was shut down on purpose. A switch that gets turned off can easily get turned back on. Knowing the difference doesn't eliminate the fear, but it changes what you do with it. 5 years later, it happened again. April 2nd, 2025, sweeping tariffs announced on nearly every U.S. trading partner. Markets lost trillions of dollars in 2 days. Hong Kong dropped 13% in one session, worse since 1997. Taiwan had its worst single day in history. The Fear and Greed Index sat at extreme fear for the entire month of April. Then April 9th, the tariff pause was announced. The S&P 500 goes up 9.5% in 1 day, one of the best single days in decades, then drops again the next day, then recovers. New all-time highs by late June. I've seen this pattern before. Tariffs are a policy decision. Policy decisions can be reversed, paused, negotiated. This wasn't systematic failure. This wasn't fraud buried in the foundation of the financial system. This was a known variable. I watched the technicals, and when the signals told me what I was looking for, I started cautiously buying again. Building positions gradually, not trying to chase the bottom, not going all in, just methodically adding as the market confirmed the direction. And here's what April 2025 confirmed for me, that 2020 wasn't just luck. The same framework, understanding what caused it, knowing what you own, sizing your position right, not chasing the bottom, build positions gradually as the market confirms, worked again in a completely different situation. That's not coincidence. That's a repeatable process. The market will always find a reason to make you feel like this time is different. Your job is to have a framework that is stronger than the feeling. And here's what I want to leave you with. The two most recent market drops came back fast, but they were both caused by something external and visible. A pandemic, a tariff policy, things that could change, pause, or eventually pass. The two that tested me the hardest, the dot-com crash in 2008, were caused by something that had been building for years inside the system itself. Nobody knew the full depth of what was going on while it was happening. Not investors, not the people who were supposed to be watching, not me, standing right there inside the mortgage industry watching it happen in real time. And right now, I'm watching a market at all-time highs with an AI story that sounds a lot like the internet story. I heard in 1999 that technology is real, but so was the internet, and the NASDAQ still fell 77%. When the next serious downturn comes, and if you stay invested long enough, it probably will, the headlines are going to be the worst you've ever seen. The people around you are going to be selling. Your gut is going to be telling you that this time is different, that this one isn't coming back. I've had that feeling more than once. It was wrong every single time. I'm not telling you it's going to be easy. I looked at my portfolio in 2008 and basically gave up on selling because it had just dropped so far. It almost felt like it didn't matter anymore. I owned stocks in 2000 that eventually were wiped out. I made mistakes, but I learned from them. And those lessons are the ones that I walked you through today. In a coming video, I'm going to show you the technical signals that I was watching in 2020 and also in 2025 that helped me decide when the selling pressure may have exhausted itself. Not to predict the exact bottom, because nobody can do that consistently, but to avoid making emotional decisions. When the market's moving fast, you can't get in the way. So if you're trying to understand investing without the hype, the panic, and without people talking over your head, subscribe to the channel. That's what we're here for, trying to help you build it. Real financial education from someone who's lived through it, made the mistakes, had the fear, and learned the lessons. And I'll see you in the next video.